Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, August 15th, 2022. It is 10:11 Eastern Time as I'm starting the video. I usually like to wait at least about a half hour after the markets have been trading for the day to get one out there. Usually you see that initial, a post-opening reaction often faded. Not always, but I like to just wait for that. I call it post-opening noise, a lot of order imbalances in the morning. So let me go over, here's what I'm going to do in this video. I'm going to go over the charts. I'm going to talk on the equity markets. I'm going to share my thoughts. I see an increasing chatter on the comment section. A lot of people concerned that the current, I tell you what I'm doing. You guys do what you want to do, but I'm still short. Still expecting a considerable drop. I'm talking about a 10% drop in the coming weeks here, and I know that's again from just kind of the chatter in the comment section. A lot of people second guessing that, and hey, that's fine. I always say do your own thing. Use stops, take trades that you're comfortable with. Use stops that are in line with your risk tolerance. I always say if you're long or short a position, it's going against you. That's the old saying. I didn't make this one up. Sell down to the point at which you can sleep at night. And if that means all of the position, then that's what you need to do to be comfortable. I am also going to, I'm going to bring this up again. I am going on vacation. I'm leaving early Friday morning before the market opens. Gone all day. I'm taking boat down to the Keys, running it down there. So I'll be off. No chance of doing any updates all day Friday, and probably not until at best over the weekend or early next week. I'll be returning back late Wednesday. So again, I'll be here this week, but not in front of my desk a whole lot. I got a lot of prep work to do for that trip, so I'm going to be in and out. I just want to say that. Supposed to be light, so I'm going to try to pack my thoughts into this video now, and then I will give you some updates certainly before I leave town. It just won't be a lot of active updates, and it may take a little while to get back to any questions. All right, starting out here, QQQ, nothing's changed. Yes, we did have a breakout candle above the downtrend line, but we're still in that range. Remember, this box here is the max bounce target range from back on the lows, and we're still at the very bottom of it. And so anything's possible. Is that good that we didn't get rejected the trend line? No. I'll say this: the market's been very resilient. We had a full tag of the 200 exponential right there. We had a reaction, and the buyers have stepped in. So the bid has been voracious. I can tell you from the comment section too. Again, as I said, a lot of people second guessing this. I always say, one of the terms I've made up. I always say this over the years. That old saying, patience is a virtue. Well, so I say if in life patience is a virtue, in trading it is an absolute necessity. So what that means, if nothing's changed, that's what I tried to convey this morning. When you get out there, we look at price resistance. I go down to that 60-minute chart. I have two variations. I'll give you that one today. This is the one I gave you last week. But there's where we were on Thursday, right around that 330. And remember, on a 330 point security, every 30 points is only 10%. Every 33 points, so every couple points is a fraction of a percent. It's not much. So for all intents and purposes, we're still there. And I also say this: when you're swing or trend trading, all that really matters is at least a daily close, if not a weekly. This is just, again, from my experience. When you look at weekly charts and daily charts, you want to see a solid weekly close above a level you're looking at, whether it's a key moving average or a downtrend line. That's what you look at on the weekly, and that's far from a solid close. We pretty much closed on this weekly chart of QQQ. Let me tighten it up. Hit the top of that candle, the top of those two candles, and there we are. So we closed just marginally above it. Is that good for the bearish case? No, but it doesn't really. Again, to me, that's pretty much a close right on the trend line there. So we'll see how this week closes. Again, I won't be around Friday to do an end-of-week update, but that's what you want to look for. If you see, now that we're above the 200 slightly and above the trend line, you see a solid reversal, big red stick this week, which I expect that we'll get, that's going to be pretty darn bearish. Why? Because this is a bull trap. You're sucking in bulls right here, longs. Please don't ever take any, offense or to the way I refer to bulls or bears. I'm just metaphorically speaking of buyers or people who are at that point in time bullish. And so, sometimes I'm a bull, sometimes I'm a bear, sometimes I'm long, sometimes I'm short. Just vernacular there. So that's it. I don't want to add much. There's not much more to add. I got that post out to you this morning. We're right about where we were earlier today. I think we saw a little surge this morning in buying. But let me just say, what's keeping me, unwaveringly bearish right now in staying short are these divergences. They're a big part of my trading. They're not the be all end all. And I'll tell you, if they get taken out, we blast on through there and just take out these previous highs. That would be very powerful technically. To see divergence, a setup like this. But right now, it's still the most one of the most bearish setups I've seen for swing trading in quite a while. And again, my targets kind of showed it easy on the arrows I drew today. Let me pull it back down. So there's the divergences. First, pretty good. Well, these are the levels. That's updated 60-minute chart I got out to you this morning. I clicked the wrong board. These are also levels there. 312.75 is the first support there. In there, I have at a little micro level at about 319. I'm going to round that off for you. But as far as a reversal here, again, I'm trying to convey the fact that it will have larger bearish implications if we get rejected here, and then that would likely bring us back. I'd expect a bounce or buyers to step in on that initial pullback to about 315 or so there, and then ultimately probably work our way back down to this trend line. And that again is about a 10% drop if we come on back all the way down here to this trend line and or 296-ish level. Let me just remeasure it, make sure that's what I was looking at there. Again, it depends how long, if and when we get there, but yeah, that's a solid 10% drop or so, 10.5 down to the 296 level, and if it takes a while to get to the trend line, it might be 9% or so. All right, so that's it. And look, if we start going up through here and start burning through divergences, and then we make a run at the 200-day. Remember, the 200-day, the 200-day simple moving average from today's highs is only, again, just as it was. This is just a repeat of my analysis on Thursday. This is where we were on Thursday, and this is where we were on Friday. Here's Friday's candle. There's Thursday's. There's a high. We're trading exactly where we were Thursday. We're trading exactly where we peaked on Friday. So I'm beating a dead horse here. If anything changes, we start to get away from here. We build on there, move solidly away from those 200 days. Especially we close the week Friday. Well, hey, that's bullish. It has the potential to take away these divergences. But I still say you get up to that 200-day, and there's just a mountain of resistance overhead. You have a big area of consolidation right there. You can see that in that area of consolidation. The top of it's a little bit above that, and the bottom of that level is right about there. So, anywho, I still think the RR is favorable to remaining short right now, or being short. And one last thing, well, you see it on the 60-minute chart here. You've got, you can draw a little trend line like this, and maybe that might come into play. There's not a lot of reactions on it yet, but let me show you the futures and then I can move on. NQ, NASDAQ 100 futures, we're zoomed in here, but this is a 60-minute chart. I'll zoom out in a second, show you a little bit bigger picture. But there's that smaller trend line. That's what I thought I was going for in QQQ. You can see it better on NQ, the NASDAQ 100, because you have at least 3 distinct reactions right there so far, and that helps to validate it. And so, sound like a broken record. We had divergence there. We had divergence. Divergence just keeps growing. Again, it's been we've been resilient. The market's been resilient, but it's not going up. That momentum has stalled. We've gone up ever so slightly again. So I have to be technical because I know sometimes people say, "Oh, Randy, of course we're going up." You measure it out. Go back out to QQQ, and you can do what I just did. You can go to a daily chart, zoom in, turn off all the lines, and say, we were at where we were right now on Friday. We're at where we were on Thursday. We're just a hair below where we were last Wednesday, and you go all the way back to when we first tagged or almost tagged the 200-day there, all the way back on Monday the 8th. And from that point, the high of the market then, right now we're up 0.79%. Okay, I'm done. That's it. So no change there. PPOs are poised to make a high level bearish crossover. See how it's starting to flatten out? It hasn't crossed down yet. Last time we had a high level bearish PPO crossover was right there. And everybody at that point in time, I'm sure the masses felt as bullish as they do right now. That's what you feel there. Just like everybody feels all out bearish and thinks the market's going to continue to go down forever right there when it stopped going down. And then, you got the bullish PPO crossover right there. Okay, on a closely related note, somebody made a comment, threw out a question regarding China and possible problems with their banking system. And you probably saw the headlines today. They just lowered interest rate. Their growth is slowing over there. They've certainly got their problems. You read the headlines. They've got big time problems in the real estate market. A lot of properties that were supposed to have been built didn't. Investors or individuals, citizens getting upset with what's going on in the housing market. So, anywho, my response was I'm not an expert in China, but I think the question that was put to me in the under that comment section was, how it's going to be bullish for crypto. A lot of money moving out. Last I heard, China banned crypto a couple of years ago. They don't, and China doesn't mess around. It's not like the U.S. We're very lax. All our civil liberties, we can do what we want to do, and regulators have been trying to crack down on crypto forever, but they just can't because they allowed all the institutions, hedge funds, and all these financial institutions got their hand in the cookie jar, and so they can't pull the rug out. But anyways, okay, I'm rambling here. Bottom line is I go off technicals, okay, first and foremost. And and my reply was this mirrors the stock market. And as I've covered 101 times since November, way back when it was, the thoughts were that crypto would be a new alternative to the dollar and also an alternative asset to hedge against stock market risks and all other kinds of things. Well, it is since the stock market peaked, and I'm talking about the risk on NASDAQ 100 peaked back in November. As I've said many times, that's exactly when crypto peaked in November, and they have moved down in lockstep and they have moved up in lockstep. Remember, the market bottomed back in mid-June, and that's about when crypto bottomed. And later, a little bit later, it's following the stock market, and it didn't bottom randomly, just like the stock market. And same reasons we covered shorts and reverse long on June 16th, or at least I did. That's where right after that, the case was made to be long crypto, and it's been going up with the stock market. And this is Bitcoin, by the way. Sorry if I didn't mention it. BRR, Bitcoin futures, 6-month, 2-hour candles. And that's that. There's not much more to add other than just like the stock market, we're at resistance. There's resistance right there, about 24,280 on Bitcoin futures, BRR. We have negative divergence just like the stock market. And when that breaks, I think we're going to get another leg down. And if I'm wrong, we keep going up, and there's your next resistance. You got a little big old gap right there, an unusual gap. Let's see one that big, and then massive resistance right there, which was initially my target, but I told you I don't think we're going to get there, at least not without a big down first. We could get there if the stock market goes down, QQQ hits that primary uptrend line off the lows that I'm targeting right now, that 10% or so drop. We could see crypto come on down, and then maybe the stock market and crypto make another thrust higher. But I'm also at this point in time, because my minimum bounce target range has been hit without a significant pullback first, what on QQQ I'm talking about, I'm very much open to the possibility that may be it. If we do peak around these levels, then that very much may be it for the bear market rally. And what I mean by that is we don't take out where we're at right now. We go on down at least before we take out the lows. So in other words, we go down, we ultimately take out that uptrend line that I'm targeting at about 10% downside, and we also take out the mid-June lows in the market, and then crypto also gets another leg down with it. So, but right now, okay, gosh, Randy, what do I do? Which way is it going to go? I don't know, and again, I'm not going to be actively trading this week, but I can tell you this is a rising wedge pattern right here on Bitcoin. You had a downtrend line. It was taken out, but look at the price action since. Just like when QQQ took out that trend line, I started with the primary downtrend line when I started the video. The breakout, there's been no follow through. When a security breaks out, of a well-watched resistance level. You want to see, typically you want to see the buyer step in, volume increase, and security go up impulsively. That has not been the case. Now the breakout hasn't failed yet, but it just there's not a lot of buyers behind it. So just keep it simple. Watch the markets, watch QQQ, IWM, SPY, watch those support levels, and if you break this wedge, yeah, you've got some support. Then you want to see 22,352 break, and then the big bearishness would be if we break down here. We get down here, you've then failed a back test of the trend line, because in a perfect world, it breaks out here, maybe the wedge breaks down, it's a false breakdown, short sellers step in, they ramp it up, the buyers step in, ramp it up. But if you fail this, then that's a failed breakout. It's probably going to be pretty ugly. So just stay flexible. That doesn't have to happen. I can't tell you with the highest degree of confidence that's going to happen right now. But what I can tell you is these are the levels to watch, and watch it in conjunction with the stock market. What does that mean? Well, so let's say Bitcoin does break down and loses the trend line and breaks the wedge and starts moving down here, but all of a sudden the stock market pulls back to one of my earlier support pullback targets and rallies hard, and then the charts start to firm up and it's constructive. Well, that could be then a whipsaw there. So, yep, whipsaws abound in this day and age, thanks to the algos and higher volatility during a bear market. You're going to see moves like that. But as of now, this is my preferred scenario. So if we break down, the market's going to go down hard in the next few weeks, is what I still suspect. And there's going to be a big move down in crypto if that happens. It's a contingent trade. To be long in bullish one right now is to be long in bullish the other. That was a takeaway I gave to my reply to that comment earlier today that I made. You're not diversified if you're long or short both the stock market and crypto. The other one I've been tracking is Ethereum, and you can trade either you can trade the raw crypto. You can use one of the ETF type instruments like ETHE, or you can trade the futures. These are the futures, ETH USDRR. So Ethereum on US dollars there. There's your primary downtrend line. Just like Bitcoin bullish, it broke it out. But we all see what we want to see. It's like those ink blot tests. Everyone sees what they want to see. And look, I saw that. I was long crypto and bullish there and gave you these targets. We actually exceeded that max target already. But what I'm seeing now, just like in the stock market, I'm seeing these 60-minute bearish rising wedges, and I have alternative trend lines. So you zoom in real tight. So the lower one would be what I call the BOD, or benefit of the doubt trend line. So you have one there that catches a lot of reactions but excludes one little spike there. But if I catch that spike, we come in here. So you want to see that taken out. And then look, this is big support. So if the wedge breaks, there's your potential bear trap scenario. Buyers should step in. Should, quote in parentheses, I'm putting that should. And maybe they will. That's about 1,700 down to 1,637. If they don't, that's pretty bearish. And then their next should be buying opportunity is on a back test of the trend line. And if that fails, then I'm not going to say it's get out of dodge time, but because you do have big support there. Remember, I harped on this trading range here. That was bullish. We had positive divergence. We got the upside breakout there, and then we back tested it here. There was a long entry number one. If you missed that, you got an opportunity on the back test, and then it's been from that breakout point, got a rough measure. It's been 60 or so % rally in Ethereum. So we milked most of that, sheared majority of the meat off that bone, not all of it, at least not me. But now, like I said, I'm looking for a downside break, and if we get that, that's going to be a sell signal. Sell signal 1, 2, 3. The ones I just covered, 1, 2, and then a failure of the trend line 3, and then obviously that you break that top of that range, especially those recent lows. At this point down here, if we get there. We might not, but if we do, that's waterfall sell-off time. That's where stops will be hit, margin calls will be triggered, and that's only going to most likely going to happen if QQQ takes another good leg down. So as of now, the momentum is up, trend is bullish, but you've got, just like the stock market, big old negative divergences building, just like you had big old positive divergences that were the catalyst for that. Actually, the whole rally off the low was about 100%, and that's that. All right, let's move on. A related trade, I would be to the stock market and crypto because it's risk on. This is, the one of the biggest. Tech is the biggest component of the Nasdaq 100, and stocks, the semis are pretty much the leading indicator for not just the stock market, but certainly for tech. So semis are kind of the canary in the coal mine, and it's also just a more juiced up way to trade tech. If you get a rally in the Nasdaq 100. And it's, let's say, 20%. Those semis are probably going up 30 or 40. It's like trading GDX or the gold mining stocks instead of trading gold. Just a higher beta play there. And so we had it as a long here. We hit 1, 2, 3, all three targets. I canceled the fourth. Said now that's three. T3 is now my final target. Reversing there, made it a short before there with an add-on to come on the break of that. We hit T1 as expected, had a reaction off there. I highlighted this bounce back there as an objective short entry. So far that didn't work, but look, we're right back to where we were. We're exactly today. We stopped at that last high, and in addition to that, not only were those negative divergences not wiped out or negated with higher highs, they were extended. You can see the indicators continuing to make lower highs, right? That's negative divergence. So whereas this was a divergent high, this is an even bigger divergent high because you have longer or more powerful divergence on the indicators. So it is another objective short entry. If we go up even higher, here's the thing about this. I might not be here this week to cover it or next week. But if that should be the case, we push up. It's not far. It's just like the Nasdaq 100 with about another 2% or so upside to the 200-day. Look at this. We got pretty good resistance there at about 434. I'm talking about these previous highs. And let's look at what would happen if we get a little rally today and into tomorrow. A little more upside. It's simply going to extend these divergences. These indicators are lagging so much that a pop there. Now, if we go much above there, yeah, we can take the divergences out, and that's going to be bullish. But as of now, let's see if we get up there from where we just peaked this morning. You're talking about less than 2.5% up to that next resistance level there at about 434.22. And then I always keep the bigger picture. I may not cover it every video, but this is our primary downtrend line on SOX, the semiconductor ETF. This is our bull market uptrend line. So the semis, say what you want. I know the media will tell you we've been in bull, we're in a bear market, and now they say we're in a bull market in the Nasdaq. That's all hogwash. It's just corrective wave up, I believe. And this is a long-term bull market trend line, so the semis can still fall just to hit that. That has been my long-standing since back here. Put in that divergent high. The semis already fell. They fell from the peak, the divergent high. They hit my first target on the weekly. It was a 31% drop. They hit it back here. When the market bottomed, remember that was a reversal from short to long with everything, so that included semis, even though we weren't at T2 yet. That was a drop of 41%. And if T2 is hit, it's going to be a correction in the semiconductor sector of about 50%. And again, it's just going to be a simple, yeah, they'll call that a bear market. Technically, by that whole definition, it is. But that would be just a correction back to the primary bull market uptrend line. And that would be a great time to go long. That's the pre-COVID highs. A lot of the indexes I'm targeting, same level there back in 2020, right before COVID hit. And a very doable target. I put a high degree of confidence that target will be hit. $1 million question, where do we stop? I think we either stop right here where we're at now, hence the reason for being short. There's our primary downtrend line. And if that doesn't do the trick, look, I've had this level here for quite a while. It's S1 because it was support, now R1. It's 435.83. Big resistance level. It was a resistance here for a while, about a year, well, half a year, 6 months. Then we broke above it, we back tested, then it was support, then it was support on a weekly basis. Don't look at these little skinny parts. Those are just shadows. Look at the weekly candles. Finally, boom, you had a weekly close below, boom, that was the next leg down, then you back tested it. Support once broken becomes resistance. So this all meshes right here with just a little more upside. There it is, about 2.5% above today's high. So I sound like a broken record because we've been here for 2 or 3 weeks, but I say this because I see the frustration in the comments, And hey, at the end of the day, I may be wrong, but I maintain what I've been saying now for there it is. We're where we were. This is 3 week. These are weekly candles. We're exactly where we were 3 weeks ago. Boom, 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 boom. You can see that the 40 week, which I said does a great job of acting as support and resistance on a lot of tech indexes and sectors. And you can see, go back in time, scroll back and look at that the red line here. You can see it act as support during bull markets, support, 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 and then you broke it, and then you're in a bear market. That was a 27% correction, or a correction, whatever you want to call it. You broke it when COVID hit, 39% drop, and you broke it here. You back tested, and we're below it. So all to me simple stuff. I'm not a believe me, I'm not a mechanical trader, but when I see this, I separate what's going on in the long term with any short term. Um, Strength or weakness in a market or security. When it comes up to major resistance like this, and when you're trading, trying to call turns, trend trading, especially, you got to give it time. You got to be patient on the weekly chart. But again, nothing has changed now for 3 weeks. We hit today for the third week in a row. Today's highs made a perfect. I think you can see those little shadows there. That means as high as we got during the week, a perfect tag at that 40-week aka 200-day moving average. And remember, we already broke the trend line, the primary uptrend line right there off the lows in the semis, and we're below it now. And we just need to do the same in the Qs, and then we'll probably continue on down. There it is. So QQQ needs to do the same, and then we go lower. Okay, let's talk crude oil now. I'm going to start out longest term, go to a 1 year chart. Okay, so back here, this is the big picture on crude. We're looking at CL crude futures, and as I showed you quite a bit over the last couple months here, you had this big old bearish rising wedge pattern with big negative divergence, and that was the catalyst. So this is when everyone thought crude to the moon, and all the analysts started coming out with $200 price targets and all that ridiculousness. And then that was a peak. And again, it was priced into the charts, diversion high. And then we broke the primary trend line or the wedge. We back tested it, and then we moved down and we hit this $92. It says 91.96. Call that $92 target. I gave you a max target of 81.16, but recently I told you I don't know if that's going to be hit or not, and I'm kind of leaning towards no. I'll tell you why. I'm not trying to make this fit my narrative, but if we continue to see oil prices move down and natural gas and all commodities, it's going to help the stock market, and then it doesn't mesh with the market going much higher. And again, I'm flexible here. I'm going to watch this, and that might change my outlook on the market. But right now, you can see I just drew it. You have this bullish falling wedge. I'm going to zoom down to a shorter term chart and show you that in a second. So let me do that. Let me go to a 6-month 2-hour candle. Okay, this is crude oil again, crude futures. There's our downtrend line. This is divergence. There was that first divergent low. It was pointed out at the time. That gave us a rally of about 13% in crude, but still just a bear market rally, or whatever you want to call it, a counter trend rally, because we're in a downtrend. And the divergence is even bigger now. So I took some longs today in crude because of this, and I'll show you in a minute. Also on the shorter term chart, and we're probably going to bounce now. Based on this, we could come up and make another run at the top of the wedge. And if this wedge breaks out, go up here. So where I'm going with this crude is, of all the commodities out there, I think we can all agree, and it's pretty much fact, this one has the biggest impact on inflation. And inflation is everything right now. It's all the market's talking about. It's because it's going to determine what the Fed has to do. Everybody is cheering, the recent abatement in inflationary forces, which I talked about. We talked about in advance before it happened. That's what we would hear because the numbers are wrong. They've been dated by about a month right now coming out, the CPI numbers. But there it is. So if we get this, then this starts to put pressure back on the Fed, back on the market. And so this scenario here, at least even in the near term, a rally up. Let's just say we rally back up to the top of the wedge, and there's pretty good resistance around 92 and change up to the wedge. That's about 7%. So One day doesn't make a difference in the market, but and we're down today. It's down about 4%, but we're well off the lows. So if you start to rally up here, and if you see natural gas and just the majority of commodities start to rally, look at lumber, things like that, which has certainly come off the lows, then that again you're going to hear, because what the headlines are saying right now, and I agree with, is in the last few weeks, and it's everything I predicted a couple months ago, you're going to see that pivot, the paradigm shift, where everyone's talking about the market has priced in the fact that the Fed's going to all of a sudden become easy and stop raising rates, maybe even cut rates, and the Fed hasn't said that, and that's a dangerous thing, and that's where the next paradigm shift, so to speak, will be when investors realize that, oh gosh, it was just a temporary abatement in inflationary forces, and we're going to continue to see rate hikes. That's when you're going to get the next leg down. So let's watch this one in particular, crude oil, because maybe I'm wrong, and maybe we do head down. Like I said, I can make a case either way. I can do that at almost any point in time. I tell you what I think is going to happen. If I need to pivot on that, change my views. But this is why crude was along to me this morning. You have these recent lows right here, and you ever so slightly undercut it, but you kept this divergence right here in place, positive divergence on this 60-minute chart, and a nice reversal so far, especially considering, let me zoom in here, the fact now that we recovered. This is a false breakdown, aka bear trap. When you undercut previous lows, you get shorts that pile in, and then those shorts realize when the breakout fails, they were wrong and they have to cover, whether they're forced or whether they have stops that are hit or margin calls, or they're disciplined traders and they say, well, the reason I shorted crude this morning is because it broke those previous lows, but now that it's solidly back above there, I'm going to cover again. So that's what's going on in crude oil. And you can even go down to a little 5-minute chart, and this is what I will zero in on entries and exits. You had nice divergence there this morning on that breakdown, and that's why it was very likely to fail the breakdown. And so far, it's been a nice reversal in crude, about 2.5%. But crude's volatile, so it's nothing huge. But the fact that I showed you that it recovered those previous lows is, again, that's a short-term 5-minute chart, 1 week of price history. And then last but not least, or maybe least, let me know. Drop me a line. If anybody's trading treasuries besides me, let me know. If not, I'll maybe cover them a little less. You should even if you don't trade them, watch them, because they sometimes can give us some insightful clues to the market. In the past, they were much more accurate predictor because the institutions flocked to them. But in this day and age of excessive Fed intervention, meaning quantitative tightening up until recently, now we're in quantitative easing, now quantitative tightening, meaning the Fed has been the biggest buyer of Treasury bonds, so it completely destroyed, or mostly destroyed, the age-long process of what we call price discovery, and that is the natural interaction between natural buyers and sellers. But the Fed is obviously a very unnatural buyer, not buying for fundamental reasons like natural buyers and sellers are hedge funds, institutions, pension plans, other countries, China, Japan buying our treasuries. But with that being said, I've been covering them a lot, and they trade well to the technicals. That last bearish rising wedge there, you can see divergent high, negative divergence, then you correct it, put in a little divergent low, and with treasuries, especially futures, because they're leveraged, you don't have to have big moves. You can make a 0.25% move and make thousands of dollars if you buy several contracts of ZB, the 10-year, 30-year Treasury bond. So recently I highlighted that after being short that went long because we had positive divergence, expect to bounce, and we hit this level right now, 141, 179. We're a little bit above it. At most, and it's possible, but I closed my longs today. I closed them here a little early, right a hair above that 141, 179 level. When I got up today and sat down earlier today, I saw we were trading above there. And so where I'm going is they may fire up. That might be an overshoot, but at most I think a back test of the uptrend line, and then that 143.88 price resistance. That would be my max bounce target now. But like I said, I'm out of it because I'm not going to short yet. We're just coming off that divergent low, and there may be some more upside, or that may be it. And when I waffle like that, and I'm not sure, that's why I'm out. So I just wanted to update that for you those of you in it. And we're also seeing the fact, these are coming up with the stock market lately. There has been a kind of a flip-flop where Treasury bonds and the stock market used to be inversely correlated, but I have noticed bouts, little spurts lately where we're starting to see some return to normal. Now, the problem is that quantitative tightening from the Fed, but there are times where it appears to me that there's accumulations by the institutions in anticipation of a market correction. Historically it was pretty easy. You'd see Treasury bonds starting to go up towards the tail end of a stock market rally. It was telling you institutions were probably selling equities or stocks into that rally at the tail end of it, anticipating a correction and passing the torch off to what they call the dumb money, the retail traders. And they would accumulate Treasury bonds in anticipation of a correction, because when the correction came, the bonds go up in price and stocks fall. And so we're there are little spurts of that here and there. And at the end of the day, again, I'll let the technicals be my guide, but fundamentally, you could make a case that you're seeing some institutional accumulation here of Treasury bonds, and while the market's going up. So, but overall, like I said, that they haven't broken that unusual. It's not unusual as of late, but historically very unusual positive correlation between treasuries. Remember, the stock market bottomed back on June 16th. That's right when treasuries bottomed, and they've both been moving up. But like I said, I'm seeing here and there a little disconnect, and again, I like to just trade them on their own technicals, and not outright as a positively correlated trade, because there are little periods of opportunities there. All right, I think that's it. That's just what I want to wrap up. And again, let me know if you trade treasuries. I'll continue to share trade ideas when I see them. If not, I'll just cut back to some, to some of the bigger, the longer term analysis, if you will, which is useful for those with 401ks and stuff like that, when you want to know, when it's time to maybe shift money into treasuries or take money out of or bonds in general. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.